Awesome. Thank you guys for being here. We are Team 1. We have a team of 4. Unfortunately, 2 of them cannot be here. But my name is Alex, and this is my colleague Tara. We're all first-year MBAs. So an overview, we already heard a little bit of this, but this was just kind of our approach, looking at the case, analyzing it through the 12th edition Standards of Practice Handbook, laying out the violations that we found, and then developing our recommendation plan. So a little intro to BLIM Investment Management. We already heard they're part of a larger group, Banco Libertad, 90 billion assets under management, and they do have a mission statement that focuses on ethics, integrity, and client care. Their new initiative, so mainly 3 new items that they're implementing. So the new account based on assets under management, the new compensation scheme, so now as opposed to 90% of the base salary, it's now 25% and 75% is on a variable component. The new partnership with Prodigia Group, the mutual funds, so previously the other mutual funds did not have fees associated with it, but this group does, so there's a lot more opportunity to earn fees with this group. As we're reading it, some attention points that just like came top of mind. Are these initiatives in the client's best interest? The advisor fee structure is largely on this variable component now. There also is this $5 million payment from this new partnership. So I'm going to pass it to Tara now to kind of look at the CFA standards of practice.
Thank you, Alex. So there are 7 CFA standards of practice, and here is a brief overview of it. But moving on to our specific violations that we found that BLIM violated at least 4 specific violations. So starting off with Standard 1, professionalism. Independence and objectivity, Standard 1B. Juan Diego has compromised his ability to provide unbiased investment advice through his informal arrangement with Heber Lopez, who's the manager of the Latin American Fund. Diego is receiving material benefits for steering clients toward the Class A shares rather than the lower cost Class W shares. Specifically, Lopez allows Diego's clients to invest over $100K in Class A shares to trade at the current day's closing price rather than the next day's price, and Lopez is providing Diego with advance notice of these large block trades. So these arrangements create a very clear bias in Diego's recommendations. He's favoring Lopez's fund not because it's in his client's best interest, but because of the personal benefits he receives. So this directly violates that investment advice must be values-based and free from arrangements that favor personal judgment or professional judgment. So moving on to misconduct, Standard 1D, BLIM has engaged in dishonest professional conduct by failing to disclose critical information to clients. Ribeiro discloses client sales data and investment advisor information to Prodigia without client knowledge or consent. This breach of confidentiality represents a fundamental dishonesty and how BLIM handled sensitive information. Secondly, and perhaps a little bit more egregiously, the firm did not disclose the $5 million payment arrangement from the Prodigia Group to the clients, even though this payment is based specifically on steering clients towards those higher cost Class A shares rather than the lower cost Class W shares. And Bianchi in the case does state that they didn't disclose this arrangement because it's between BLIM and Prodigia, but this kind of wording is very flawed. They should have definitely been more transparent about that. Next up is Standard 2, BLIM violating integrity of capital markets. So starting off with material non-public information, as we mentioned before, Lopez tips Diego about upcoming block trades, and this is kind of textbook material non-public information. Knowledge of a fund manager's intention to buy or sell shares of information is something that could affect the value of those securities that's available to the general investing public. And then Diego commits multiple violations with this information. First, he shares the MNPI with select clients, and this gives them the opportunity to trade before Lopez executes this block trade. And this, violates the standard here. Secondly, in terms of market manipulation, um, clients who invest more than 100K in Class A shares of the Latin American fund, um, are not allowed to claim at, are not are allowed to trade at the current day's closing NAV after it's been calculated, and rather than the next day's closing NAV. And this practice is known as late trading and represents a fundamental distortion in artificially inflating trading prices. So now moving on to standard 3, duties to clients. Alex is going to explain this.
Yes, so we also saw a few violations here. So starting with loyalty, prudence, and care, which basically states that the client's interest should be paramount through all decisions. The fact that the compensation scheme is now favoring that variable component a lot heavier, the advisors do have an incentive to offer the Prodigia Group funds, which may not be in their client's best interest, but it does allow them to take advantage of more fees. Going on to fair dealing, so as we heard before, people in certain Class A shares are getting preferential information, which violates the fair dealing standard. So we already heard before the late trading and also sharing that block trade information, so that non-public information to those in Class A shares. And then finally, in standard 3, suitability. So the fact that they transferred everyone to this new fund, specifically those buy and hold clients who rarely trade. So now that they're in a fee-based account, they're actually getting charged more because they're not benefiting from the active management. So it's basically, you know, like you're going to a buffet, but you only want like a meal. So they're getting all this, you know, advice, but they're actually not leveraging it. Is really not in their best interest and most likely not suitable to these clients.
Moving on to standard 6, conflicts of interest. So first off, Ribeiro changed the advisor compensation scheme from 90% base salary to only 25%, with 75% is now variable pay tied to fee generation. And advisors also get bonuses for increasing annual fees by 10%. So this creates a very massive conflict. Advisors are incentivized to generate fees instead of acting in clients' best interests. Standard 6A requires disclosing all matters that could impair independence or objectivity, but Ribeiro only plans to mention this in the annual newsletter after getting feedback from advisors. And this, you know, violates the requirement that conflicts be disclosed timely, prominently, and clearly, not buried in the newsletter after the fact. But I would also say the bigger undisclosed conflict is that $5 million payment from Prodigia to BLIM, with 75% going to the advisors as bonuses.
So moving on to recommendations. So as we did note in the case, everyone did have the CFA. So they're automatically violating that number 7 on the standards by violating any one of the standards in the standards of practice. So we came up with a plan for, of course, these professionals to align with the standards, but also with local regulation, because some of the things they're doing is just outright illegal. We noticed they are in South America and Uruguay, so we looked up their standards as well. They're very similar to ours here, the SEC, just they go by a different name. But a lot of things were illegal. So we recommend a 4-step plan outlined here, based on transparent client communication, diligent and objective recommendations to clients, prohibition of late trading, and also the ban on front running, and then also just general enhanced compliance. The profession is based on trust with clients, and the public needs to have confidence that those, of course, who hold the CFA designation are doing what's in their best interest, but also for the integrity of our markets, for a healthy and thriving market, we should be upholding these ethical standards. And finally, you know, ethics is just not a nice to have. It is crucial for a successful and sustainable financial career. And that concludes our presentation.
Judges,
And thank you.
have up to 10 minutes to ask some questions.
All right. Well, congratulations. Well done. It's always tough going first, but you ladies stood up there and did a great job. Could you talk to me about the one of the paragraphs in the case talked about the schedule of onboarding clients to the CID, kind of annuitized platform? Can you tell me about that schedule? It was, I think, front-loading the largest client accounts. Do you have any thoughts on that? Either how they're doing it, biggest clients to smallest clients, or how they're doing it over the quarters? You remember that paragraph?
Yeah, definitely. So it seems like they were kind of taking advantage. You know, Alex mentioned a little bit about that all-you-can-eat buffet and how they were kind of taking advantage of, I would say, clients that were not as well informed of how they should properly allocate their funds. And I from what I remember, I believe they were allocating clients with kind of a lower portfolio into those higher CID amounts. And in my opinion, that definitely breached a bunch of those standards because clients were unaware of how their funds were going to be properly invested, and they were kind of putting them in the more expensive share classes so that the advisors were getting a higher fee generation, a higher service fee based off of that.
Okay. Thank you.
Can you speak to, or throughout the case, Ribeiro, he's a supervisor. Can you kind of speak on his approach and how that from a responsibility of supervisors, how that kind of affects what was going on specifically, with the Prodigia, kind of new mutual fund and implementation of that.
Yeah, I think so. He was kind of discussing it with some financial advisors, and he, even before like telling the clients, he said he wanted to get the feedback from the financial advisors first. So kind of seeing if it benefits them first before the clients. I think that was his mindset, to make sure like his guys, are getting the money they need first before actually determining like what's in their client's best interest. So I think his mindset was pretty flawed from the beginning. Going into it that way, to like kind of tell the clients after the fact to make sure the benefit is extracted first.
Thank you.
Could you just walk through if this arrangement with Prodigia was known, how you would have approached the relationship and notifying clients, or how you would have approached it from start to finish, knowing the arrangement was built in?
I think being transparent with clients in terms of communication is essential. I think first off, informing them of the arrangement and how it would impact clients of different levels. That usually, creates buy-in from clients, and then they could choose whether they wanted to engage in those services with BLIM or not. Because fundamentally, Alex had mentioned towards the end, BL investment management in the short term, might be getting a lot of value by taking advantage of their clients, but 1 year from now, 3 years from now, 5 years from now, their client amount is definitely going to go down, and I think transparent communication would have prevented that.
Yeah, and just one thing to add, if they were going to go into this partnership, to not change the compensation scheme, since it's a partnership that's heavily reliant on fees. I think, if they could have kept it still fair, where mostly is base salary, so that the advisors weren't really incentivized to take advantage of those, the extra cash that they can get from the fees with this partnership.
Thank you.
Regarding the share classes, that's a big part of this case.
Mm-hmm.
All the different mutual fund share classes and the decisions to put clients into certain share classes. Can you talk to me about how they decided to do that using that matrix, and what your thoughts are on how that was structured improperly, and where the biggest violations were on the different share classes and the decisions that they were making?
Yeah, I think so. They mentioned like the Pareto principle and things like that. So if they're spending like 80% of their time, but they're only getting like 20% in terms of revenue, I think they were trying to disguise it as, okay, you're paying more for our for more service, basically. They kind of what they were going to share with clients was to say, okay, you get this many meetings with us, you get more phone communication as opposed to just email. So they kind of like put a disguise over it of, you're getting more service, but it was actually kind of planned before based on how much fees they could get from the clients as opposed to kind of the service first approach. So
how do those different share classes create fees in terms of like the A shares, the institutional shares, the W shares? Do you understand the breakdown of the different share classes, the expenses, and how that works?
If the advisors were to put clients into the Class A and C shares, they would get a higher return on those shares. The advisors would be getting it's a higher fee structure with those versus Class W shares, which a lot of those clients, if they had I guess a more unbiased investment advisor, the advisor probably would have steered them towards those.
yeah, and I think Class W also had like the most assets under management as well in the Class W shares.
Okay. You guys have any other questions?
I'm good.
Okay, I guess I'll ask one. I guess we have a few more minutes. Not to let you guys off easy, because I'm sure we're going to warm up as we go. What are your thoughts about treating clients with $100 million versus $1 million? Can I treat them differently? And where do I need to treat them equally? What are your thoughts on just because a client's paying me, 100 times more, not 100 times, but say they've got the value of a portfolio that's 100 times larger. Are you allowed to? How can you treat them differently, and how can you? And how do you need to treat them fairly?
Yeah.
I think that you should probably be treating them differently in a bunch of different aspects. The the client with $100 million in their portfolio has the ability to be in probably that Class A shareholders where they can have more risk on their returns, and that's a little bit more beneficial toward the client, their portfolio, and their needs versus that $1 million client, which in this case probably would have been steered towards those Class W shares.
Yeah, and I think inherently one thing like where you would treat them differently is just to kind of discuss with the client what are their goals, what's their risk appetite. So I assume someone with more money, more leverage may have a different risk appetite, so you could treat them differently in the sense of what you do with their money, but essentially from the get-go, just establishing that baseline with them, their goals and how they see the vision of your relationship. I think both of them deserve that respect, but just naturally, since we're talking about different figures, they're going to have a difference in terms of what they're able to do with their money.
Yeah. Thank you. Good job, ladies.
Thank you.
Thank you
Yeah.
very much.